Verasity is one of the riskiest but most volatile cryptocurrencies in the space. When the VRA token goes up, it goes up massively. Almost 14,000% gains in less than half a year. But there's also the occasional drop of 97%. You don't want to be in VRA when that happens. So really, Verasity is the ideal token for market timing. You don't necessarily want to buy and hold this altcoin. You want to time this. You want to be in when everybody is hyped about it, and you want to exit quickly once the hype dies down. Now, the problem with market timing is that it's hard to do this objectively. Everybody can draw lines on a chart and can say, okay, there is a trend here and I think it might break and this might be a support, etc. But that's not really objective, right? People redraw those trend channels all the time, and there's no real objective measure how well that approach really worked in the past. That's why we do backtests. This channel started its growth with the simulation of buying and selling cryptocurrencies. So we can do the same here for VRA. We can simulate, depending on different strategies, what would have been a great approach in the past for VRA. And then we simply assume that the psychological patterns don't change that much over time, and that the thing that worked in the past, the technical approach that worked in the past, is likely going to somewhat work also in the future. A straightforward approach is to use moving averages, right? To be in the market whenever the price is above, and to be out of the market or even bet on falling prices whenever the price is below the moving average. So we would be betting on rising prices here, make this rally, and we would be betting on falling prices over here, make money while VRA goes down by almost 90%. Well, this opens up a whole new can of worms. What moving average duration is the best here? Because this is the 200-day. Why don't we take the 50-day? And why not take an exponential rather than a simple moving average? What would have been the best to time the market in the past? That's where the simulations come into play. So we run the numbers for every moving average from the 2-day all the way to the 200-day. We also run the numbers for simple moving averages and exponential moving averages, ending up with 400 simulations of buying and selling. Introducing the backtest macro Excel sheet for VRA. The data starts in February of 2021, when Verasity was at 0.25 cents, and it goes all the way to today, October of 2023. And so we can run the numbers here. We have an exchange fee of 0.2%. So there is a bit of a fee whenever you buy and sell. You can set this according to your liking. This can be downloaded, by the way, in the premium membership. We keep it at 0.2. We start with $1,000 and then we run the macro Excel sheet. And this now takes a while. So it runs now this simulation of buying and selling 400 times. This is now filling this up. And in the end, we can determine, based on those backtests, what historically would have been the best moving averages. Is it the simple one? Is it the exponential one? Is it the 50-day or the 100-day or the 200-day? And how much does it outperform just buying and holding? And how well does the strategy in aggregate work? As in, do we have to cherry pick just one moving average and that one did well and all the rest did really poorly? Or did in aggregate this approach of following the trends with the moving averages work relatively well for VRA? So let's figure this out and let's keep this running. And there we go, it's done. Buying and holding over the time wouldn't have been too profitable, minus 64% every single year. So this is a geometric average, but we do have a few moving averages that did really well. For example, here, the exponential moving average 11-day, 550% annualized, so every year. And look at this, the 25-day simple moving average, 460%, also compounded every single year. There's also a chart. This is the result in chart form. So on the x-axis, we've got the duration of the moving average in days all the way to 200 days. In black, we see the comparison of buying and holding, minus 64%. On the y-axis, we've got the annualized performance. And in here, we can see that the 11-day exponential moving average performed really well as the 25-day simple moving average in turquoise here. Those are the two moving averages that work the best. Now we can plot this as well. So we enter the durations here again. Now we've got the value development over time. In white, we've got the VRA price barely visible. In turquoise, we've got the return generated with that 25-day simple moving average. This is the same on a logarithmic scale. So each horizontal line here is a 10x from one another. And yeah, we can see the delta here is more than 100x difference. Here the same for the best exponential moving average, so the 11-day, a bit more active trading. Also very nice outperformance, while VRA trends downwards here. Our backtest pretty much kept the capital at its current value. So what have we done over here? We tried to find out, does moving average trading in general work? And the answer for VRA at least is yes, it does. In fact, when I did this backtest for other altcoins, for 80 to 90% of altcoins, following the trend with moving averages tends to outperform just buying and holding. So timing the market does make sense. The more volatile an altcoin is, the more it tends to work. On top of just confirming that the strategy tends to work, we also optimize the perfect parameters for the SMA and the EMA. And we know that in this case, the exponential moving average outperformed the simple moving average. Let's now draw those moving averages on the chart and look at the current development. In turquoise, again, the best simple moving average, and in red, the best exponential moving average. So we have just bounced off the best exponential moving average. We stay bullish if we don't drop by more than 4.7%. And if we want to be a bit less active, we could even digest a drop up to 18%. This is for the SMA. But again, the EMA here worked better in the past. It's not a perfect approach, right? Sometimes we've got these failed signals where we get really bullish. For example, here on the 29th of August, we would be buying in high just in order to then sell again low. This is looking just at day end prices. So you don't trade within the day. You simply just buy and sell according to what the price at UTC midnight is. But we don't have to overcomplicate things. And I think this is a good approach to at least set somewhat of a stop loss. So if you're currently in VRA and you're riding this wave and you only want to ride this short term, you don't want to be subject to potential 97% drops that can happen for this crypto, you could set a stop loss at somewhere around 0.54 cents. Maybe a bit lower than that because of the intraday volatility, right? The latest to sell the token would be at 0.46 cents. That's when the price crosses the SMA. And this is when historically it would have been wise to bet on falling prices. I like backtests like this a lot because they are pretty much counterintuitive, right? It's very hard to say what's the best moving average. People just randomly pick one. People just say, okay, here's the 100-day, here's the 200-day. This is a support, this is a resistance. But how well did that specific moving average really work? I do these kinds of backtests regularly. So feel free to comment down below what crypto I should be backtesting next. There's also a Telegram channel. Looking very much forward to seeing you there. Link is down below.